reoccurring guest we don't have on near enough. I'd love to have him on. He's a busy guy. But when he is on, fireworks happen. He is a four-time best-selling author. Let me just run down the list of books. The Death of Money, The New Case for Gold, all bestsellers. The Road to Ruin, and this book, and I'm kind of excited about this, is the cover art, Currency Wars. He's going to redo it. It's going to come out in November. It's going to be a kind of an extension of this book, basically a brand new book, Currency Wars in the Age of Trump. In case you have already guessed it, it is James G. Rickards. Jim Rickards, thanks for joining us today on USAWatchdog.com.
Thanks for having me, Greg. It's great to be with you again.
Great to have you on. I know you have the Jim Rickards Project or JimRickardsProject.com, but you also have a new website called Meraglim.com. It's Meraglim.com. It is predictive analytic technology based on complexity theory. It uses artificial intelligence and team science to make big predictions. One of the things you came out and did, now nobody wants to claim this, but back in the day, before the November election, everybody thought Hillary was going to win. You did not. You thought that Donald Trump would win also. You predicted that we were going to have big trouble with North Korea, and everybody's, he's made these rumblings. We are having big trouble with North Korea. So let's use your Meraglim technology and your complexity theory. What do you see coming down the road with, let's say, the financial markets? A lot of people are calling for a big correction this October. What are you seeing?
Well, thanks, Greg. Thanks for that invitation. And by the way, that series of predictions, it actually has a much longer pedigree. I'll go all the way back to, and by the way, the great thing about doing interviews like this, and I do interviews on a lot of financial television and podcasts and other venues, and I have newsletters, is that everything's timestamped. In other words, when I make a forecast, I can point to a particular link or a piece of videotape or publication and say, here's what I said on such and such a date. So you're right. After the fact, everyone will raise his hand and say, oh, yeah, I saw that coming. Often very few people did, but we can back up our claims with, as I say, very specific publications, interviews, and so forth, all of which are timestamped. But I'll go all the way back to September 2013. That may seem like ancient history, but if you remember at the time, in May 2013, Ben Bernanke, chairman of the Fed at the time, said he was going to start the taper. He didn't start the taper. He just said he was thinking about it. That caused a meltdown in emerging markets. Anyways, at the FOMC meeting, the Fed FOMC meeting in September 2013, the whole world was geared for the beginning of taper. And I said, no, they're not going to do it. And I based that on the fact that there had been this emerging markets meltdown, capital outflows from emerging markets back to the United States, global unwind of the carry trade, a lot of instability, borderline financial contagion. I said, that's not the environment in which they're going to do anything as extreme as start the taper, and they didn't. So that forecast was correct. They actually did start the taper in December, but that 3 months was to give them time to get over that crisis. Same thing in September 2015. Remember, there was an FOMC meeting then. The whole world was ready for liftoff. Liftoff was going to be the first interest rate hike since, I think 2006 was the last time they raised rates. The first one since the zero interest rate policy getting off of zero. And I said, no, they're not going to raise rates in September 2015. They didn't. I had a very specific reason for that, which was that between August 10th and September 10th, the stock market fell 11%. That was in response to a Chinese devaluation. That's, again, no environment to be starting the liftoff. They started the liftoff in December, which we saw coming, so forth. Same thing with the whole string of meetings in 2016. The Fed said we're going to raise 4 times. I said, no, you're not. You won't raise at all for the year. Got all the way to December before the first raise. We did see that coming, but for those first 7 meetings, they didn't touch them, and that's what we said. And even before Trump, I said that the UK would vote for Brexit, that they would vote to leave the European Union, and they did. And then I was going around the world. I was in Australia, UK, other venues on financial television saying that Trump would win, and he did. And then since then, we've had other strong forecasts. So the point is, it's a very long run. And then the question is, how do we do it? Do we have a crystal ball? No. Am I smarter than anybody else? No. I guess I'm smart enough, but there are a lot of smart people out there. I don't have different facts. We all have the same facts. What sets us apart when I say us? I'm talking about this new company I started, Meraglim. Again, thank you for mentioning the website. You just go online, mirrorgleam.com, easy to find. I started this company a little over a year ago with a partner, Kevin Massengill. Kevin's our CEO, awesome guy, former Army Ranger, achieved the rank of lieutenant colonel in the military, worked in military intelligence on the front lines of various wars in the Middle East we've had since the first Gulf War, and then certainly after 9/11. As I said, great business partner. I met Kevin in Bahrain doing a war game, a closed-door war game with players from around the world. Pardon me, financial analysts, policymakers, economists, and others. And Kevin was out there as a representative of a major arms manufacturer and technology company, and we just kind of hit it off and stayed in touch. Anyway, we've started this company that can automate using artificial intelligence, using various scientific disciplines, that can automate these models that I've been using all along to make these forecasts, which have proved highly accurate. Now, some of this stuff comes out of two experiences I had. One was 1998. I think I've spoken before about how I was the general counsel of Long-Term Capital Management. That was the hedge fund. Pardon me. That was the hedge fund that melted down in August, September 1998. I had a front row seat on that. But we had 16 PhDs. We had Nobel Prize winners. We had all the financial talent in the world. And yet, from a risk management point of view, that was a disastrous meltdown. I came out of that. I wasn't the risk manager. I wasn't the PhD economist. I was the lawyer. I brought that in for a soft landing and negotiated the bailout. But I came away from that very dissatisfied with the state of financial economics. I said, look, my partners weren't dumb. They weren't, it's not that they weren't working hard enough. They were smart people. But clearly the models were wrong. Clearly their understanding of financial economics was wrong or obsolete. There had to be a better way to do things. And I spent years, really the better part of a decade, figuring out what went wrong, studying physics, applied mathematics, network theory, graph theory, behavioral economics, many other disciplines to, first of all, critique the standard model and find out what was wrong with it, which I did, and then to advance my own models, which worked a lot better. Around the same time, this was in 2002, and then through the rest of the 2000s, I was tapped by the CIA to work with them on counterterrorism. That was based on a lot of experience I'd had working in banking in Pakistan. From years past, I worked at Citibank and spent a lot of time in Pakistan, the Middle East, the Gulf. I knew a lot about Islamic banking. I knew a lot about the region. And after 9/11, it's pretty well known there was insider trading ahead of 9/11. The last two trading days prior to the 9/11 attack, the put volume, when you buy a put option, you're betting that the stock's going to go down, of course. The put volume in American Airlines and United Airlines, the two targets of the attack, was 286 times the average daily volume in those stocks. And so clearly, a lot of people knew that the attack was coming. Nothing surprising about that. And what the CIA said was, well, okay, if there was insider trading ahead of 9/11 and there were going to be another spectacular attack, would there be insider trading again? Could you spot it? Trace it to the source, get a FISA warrant, break down the door and stop the attack and save American lives. That was the CIA's mission. They called that Project Prophecy. I started out as a volunteer, then became a contributor, then became co-project manager, then worked for the CIA for many years, developing basically a new discipline called market or market intelligence along with some partners. But one of the tools we used there was something called Bayes' rule. It goes by different names, Bayes' rule, Bayes' theorem. Named after Thomas Bayes, a late 18th century Presbyterian minister in England. But he invented or discovered a mathematical formula that is a very powerful predictive analytic tool. It's what you use when you don't have enough information. I always say if you have all the information you need, a high school kid can solve the problem. How do you solve life and death problems when you don't have enough information? Well, that's where Bayes' rule comes in. So basically, coming out of the long-term capital management debacle, where I studied complexity theory and behavioral economics, and then working with the CIA, where I learned to use Bayes' rule and counterterrorism, and then other geostrategic efforts. We've now combined all this in a private company with our investors and the folks I mentioned, teaming with IBM. We're working with the Idea Lab at IBM, working with their Watson supercomputer. On the Miraglim team, we have a fellow named Terry Rickards, a PhD, mathematician, applied mathematician, statistician, super guy, very, very seasoned in capital markets, also has an intelligence background, as do I and as do Kevin. So basically, we've got other folks, engineers, coders, financial people, marketing team, et cetera. We put this together, having a lot of fun with it. But basically, we're using 4 scientific disciplines. The first one I mentioned, which is complexity theory, comes out of physics. Second one, applied mathematics, which is Bayes' theorem. The third one, behavioral economics. This was the field really advanced in the 1970s, 1980s by Daniel Kahneman, who won the Nobel Prize, Amos Tversky, Dan Ariely, and others. And the fourth discipline, believe it or not, is history. History is not dry, and as the cliche goes, history is not history. We're living history, and there's a lot about history that we can use. And that's what my book Currency Wars was about. Most of the book Currency Wars, which came out in 2011, a lot of it was forward-leaning, predicted the currency wars would last 10 or 15 years, which they have. But a lot of it was financial history, looking at what I call Currency War I, Currency War II, the classical gold standard of 1870 to 1914, as a way to draw lessons. So 4 fields, complexity theory, Bayes' theorem, behavioral psychology, and history, all combined with a team to give us very powerful predictive analytics. We have all the successes I described and a lot more predictions to come.
So what is your prediction for this fall then? Let's get back to that. Your prediction for this fall, a lot of people are thinking, I just had Gordon Long on, thinks we're going to get a scare this fall, and they're going to go into hyperdrive trying to fix it. What's your prediction for this fall for the markets?
Well, I think markets will have a very violent reversal in late November, early December. Let me be very specific about why, because the thing you know about me, Greg, I never make claims like this without backing it up with not just empiric evidence, but also an analytical method. So here's what's going on. Right now, as we speak, in early October, markets are priced for a Fed rate hike in December. That's based on the September FOMC meeting, Janet Yellen's press conference, a speech that Janet Yellen gave on September 26. Markets have interpreted this as clear signaling that the Fed intends to raise interest rates at the December FOMC meeting. I think it's December 13th, but right around then, December 13th, or within a day or two of that. As a result of that, what have we seen? We've seen yields to maturity on 10-year notes go up, bond prices go down, the euro go down, the dollar go up, gold is going down. There's a set of trades all based on this rate hike in December, and the stock market continues to power higher. It's almost got a life of its own, nothing short of World War III. I'm not even sure that would slow down the stock market. But the stock market is interpreting this rate hike as a sign of economic strength. And therefore, earnings projections will be validated, stocks should go up. Everything I just described, with the possible exception of the stock market, is set for a violent reversal because the Fed is not going to hike interest rates in December.
Oh, that's a big one.
Yeah, and let me explain why. So the market has this wrong. By the way, this is not unusual. Let's just go back to last winter. From January 1st to February 26th, so basically a 2-month period, I said that the Fed would raise rates in March. And I said that as early as actually late December 2016. The implied probability of a rate hike using Fed funds futures was about 30%. And that was for the entire month of January and the entire month of February. I was here giving the March rate hike an 80 or 90% probability. The market was here giving it a 30% probability. That gap, by the way, you can make a lot of money in that gap, but the market's saying 30%. I'm saying 90% chance of a rate hike in March, persisted for the entire month of January and February. You can go back and look at the time series of the data of the Fed Fund futures. Suddenly, in a matter of days, at the end of February, the market came up here. In other words, the market gapped up to converge with my forecast. And by the March FOMC meeting, we were all saying, yeah, 100% chance. Well, that's true, but I got there 2.5 months earlier than the market. the reason for that was that the market didn't believe the Fed. The market thought the Fed was bluffing because, they went through all of 2015 with only one rate hike. They went through all of 2016 with only one rate hike. The market was saying after they raised in December 2016, the market's like, okay, here we go again. We're not going to have a rate hike. I was saying, no, the conditions are right. The Fed is going to do it. The Fed actually got worried at the end of February. They said, wait a second, we know we're going to we know we're going to hike rates, and I was out there saying they were going to hike rates. The market didn't believe it. We have to convince the market that we're going to do it. Otherwise, we'll have a train wreck. We'll actually raise rates. We got to get expectations in line with the reality so we don't shock the market. So Stan Fisher, Lael Brainerd, Janet Yellen, all members of the Board of Governors, all members of the FOMC, went out and gave a bunch of speeches in a compressed 2 or 3 day period at the end of February, and they more or less screamed, hey, market, wake up, we're going to raise rates. They were as explicit as they can ever get. The market got the message and adjusted. But this idea that, I have a forecast and it's completely out of consensus, completely out of line with the market, has happened before, and we've been validated. The market is the one that has to do the violent correction. Now, I see that happening again in the opposite direction. I'm saying the market's not going to hike in December. I'm giving it a 10% probability. The market's giving it a 70% probability. What's going to happen now is that as the market realizes that the Fed's not going to hike rates, they're going to converge, again, back to this low probability I'm giving it. So,
and that means the market will sell off. So so the market will read that as, oh my goodness, economy's not as good as we thought it was. Is that what you're saying?
Correct. And also we've mispriced everything. So what you're going to see is, in a very violent way, the dollar's going to go down, gold's going to go up, the euro's going to go up, bonds are going to rally, yield to maturity is going to go down, bond prices are going to go up. In other words, everything we've seen for the last 3 weeks, Greg, is going to reverse violently, and we're going to go back to something closer to where we were in early September before all this nonsense started. Gold was stronger. Euro was 120, gold was 1325. The dollar was lower, and 10-year note yield to maturity is about 2.1%. All that flipped. Now the 10-year note's at 233, and gold's at 1265, and the euro's down to 117. Mm-hmm. All that's going to flip back to where we were in early September once the market wakes up to the fact that the Fed is not going to hike rates. Now, why do I say that? There's a very simple Fed model. It's not one that I made up. It's one that the Fed actually uses. They tell you this so people would actually kind of listen and pay attention, which is the following. The Fed is desperate to raise rates before the next recession. And the reason is that it takes 300 to 400 basis points of rate cuts to get out of a recession. How do you cut rates 300 basis points when you're only at 100 basis points? Well, the answer is you can't. And so they'd have to go to QE4. But what they're trying to do is to get rates up to 3.25% before the recession so they can cut them in the recession. So therefore, the Fed is on a mission like a death march. They're going to raise rates 4 times a year, every March, June, September, and December, 25 basis points each time for the next 2.5 years through late 2019 until they get them up to around 3.25%, like clockwork, unless, and this is the key thing, unless one of 3 pause factors kicks in. I would say the default position is they are going to raise in December, unless one of the 3 pause factors kicks in. What are the 3 pause factors? The first one is a disorderly stock market decline. Well, that's not happening. The market only goes up, so that's not a reason. The second one is job creation below 75,000 a month. Now, it looks like we're going to see a very weak number for September coming up this Friday in the jobs report, but I doubt it'll go below 75,000. It might, in which case that would be one more reason not to hike in December, but it doesn't have to. It could be 100,000. I think that's what the market expects. But the third factor, and the one that does apply, is disinflation or deflation. And in other words, the Fed moving away from their 2% inflation goal. That's the one that applies. That's the one the market is not understanding correctly. Now,
And when you say deflation, I hate to interrupt you here, but you're talking about Illinois not being able to pay their bonds. You're talking about Puerto Rico going, bye bye, we're not paying $74 billion. You're talking about real debt destruction. People not being able to. Ohio's, in big trouble. Connecticut, where you're living, has big financial troubles, as I'm sure you know locally. I think they just missed payments in Pennsylvania. California has a heavy debt load. So does New York. Is that what you're talking about? You're talking about people missing their bond payments, debt destruction?
Well, that's the end game. That's default. That's bankruptcy. In the case of Puerto Rico,
I mean, that's real. This is real.
That's real, and it's happening. But here's my point about deflation. Why is deflation a central bank's worst nightmare? The answer is because deflation increases the real value of debt. In other words, the dollar actually gets stronger in a deflationary environment. Well, if I owe you dollars and the dollar got stronger, I owe you more money in real terms. In other words, it becomes more difficult to pay off debt in a deflationary environment because my income's drying up. The real burden of debt is going up. If I couldn't pay you to begin with, deflation is going to make it even more difficult to repay you. So you were talking about results, Greg, Ohio, Pennsylvania, Connecticut, California, Puerto Rico. You're right about all that. But imagine if we had 1 or 2 or 3% deflation where far from being able to pay your debts today, the value of the debt was going up. The defaults would be even worse. The banking system, bad debts would pile up. The banking system would be under threat. Tax collections would go down in nominal terms. The credit of the U.S. government would be called into question. The U.S. government might default. These are all the horrendous consequences of deflation, and it's why central banks cannot have deflation, and it's why the Fed has a 2% inflation target. Why is the Fed's inflation target not 0? 0 sounds like price stability to me, but it's not. They have a 2% inflation target, and the reason they say publicly is because 0 is so dangerous. We need a cushion. If we get into a disinflationary environment, we need to be able to, cut rates. So the reason they have a 2% inflation target and ultimately a more than 2% rate target would be so they have a cushion away from the 0 bound. But here's the problem: they're not getting 2%. They printed over $3.5 trillion in the last 8 years. And they cannot get the inflation. That's because inflation is really little to do with money supply and everything to do with psychology. That's a separate topic. But that signal is flashing red. So there are 20 different ways to measure inflation. You can use, PPI, CPI, core, non-core, trim mean. These are all technical terms. It doesn't matter. There's one way that the Fed looks at inflation or deflation. There's one, they look at all of them as data points, but there's one that they use in particular. It's a little geeky, but it's PCE, which is personal consumption expenditure, deflator, just measure of inflation or deflation, core, which means you throw out food and energy. Again, we don't have to debate that. A lot of people think that's ridiculous, but I'm just telling you what the Fed does. Whether I think it's ridiculous or not doesn't matter. What matters is what is the Fed thinking. And year over year, not month over month, which is different. So they're using PCE, core deflator, year over year. That's their preferred metric. Now, what is the actual data? Forget about what the newspapers say. Forget about what the websites say and what Wall Street says. What's the actual data? Last December 2016, that was 1.9%. Bear in mind the target's 2, right? So at 1.9, you're there. I say, hey, nice going, guys. You're right on target. January, 1.9. February, 1.6, 1.6, 1.5, 1.5, 1.4. It's been going down all year. And the most recent reading just came out last Friday, September 29th. It was 1.3%. In other words, every month since December 2016, for a 9-month stretch, every single month has either been flat or down, and down consistently and persistently 0.6% away from the Fed's target. Now, bear in mind, the effective range is only about 0 to 2. It can't go below 0. It can technically, but the Fed doesn't want it. So the Fed thinks of 0 as the danger zone, and they don't want it above 2 because that's their target. So the action in this index is going to be between 0 and 2%. You just lost 0.6%. That's 30% of the entire range in the last 9 months. That is moving in the wrong direction. It's moving strongly in the wrong direction. It's what keeps Janet Yellen up at night. It was what made it easy to say they weren't going to raise in September, but they're not going to raise in December either. they're only going to get 2 more readings before the December FOMC meeting. This trend has persisted for 9 months. Yellen's not going to turn on a dime. It's taken her all this time to come to grips with the fact that she doesn't understand inflation. And this is what she said in her speech September 26. I read the speech twice. Why the market interpreted it as hawkish, I have no idea. That was an extremely dovish speech. She says, we don't understand inflation. We don't understand the dynamics. We're using the Phillips curve, but we're not sure the Phillips curve works. We may be in danger of raising too far, too fast. Everything about the speech said there's a very high hurdle to raising rates in December. And that speech was given before the data just came out, the 1.3% for August that came out at the end of September. She gave the speech before that data. Then the data came out, and it was even weaker. It was even more of a concern. So that, you combine the weak job creation in September, yeah, I understand it may have been hurricane-related. I understand it may be temporary, but it's still real. So you combine that weak job report with weaker disinflation. There's no way the Fed's going to raise in December. There's no way they've got Lael Brainard's vote. There's a lot of concern across the board, not to mention all the vacancies. We haven't really talked about that. But so what's going to happen is, as we get closer to December, the Fed is going to be signaling that they're not going to raise rates. Now, there's a little bit of an asymmetry here. I said earlier that they were desperate to tell the market in late February that they were going to raise rates in March. That's because they worried about the shock of raising rates when the market wasn't ready. But this would be a shock in the opposite direction. It would be a case of not raising rates when the market thinks you will. That could be actually, the Fed doesn't like shocks at all. They like to have no drama. But a positive shock is different than a negative shock. March would have been a negative shock. They prevented it. They're not going to be as aggressive in talking about not raising rates in December because they're less concerned that would cause contagion or a financial meltdown because of the fact that it would be viewed positively by the market, even though they're not ready for it. But the point is, when that happens, and I expect it will happen for the reasons I mentioned, all of a sudden the dollar is going to get weaker, the euro is going to get stronger, gold's going to go up, and bonds are going to rally. So a lot of big market effects. So I'm not talking about the end of the world. I never talk about that. I'm not talking about a total meltdown. I am talking about a violent repricing of some major commodities and bonds and cross exchange rates based on the market's misreading of the Fed's intentions about December, because the market thinks they're going to raise and they're not.
And I want to just briefly, I know you know about this. A lot of people are talking about this yuan, gold-backed yuan, oil trade in yuan that's coming out in mid-October, and they think that could be, the world reserve currency killer, the dollar killer. What say you about this hype or all this news about China using a gold-backed yuan and also pegging it to sell oil around the world?
Yeah, well, it's a very significant development, Greg. It's a very important development. I'll talk about it. But one point I want to make is that there is a concerted effort underway globally by Russia, China, the IMF, and others to de-dollarize, to get away from dollar hegemony, to get away from the ability of the United States to dominate the global financial system through the use of the dollar. Not just for financial reasons, but also for geopolitical reasons. This is how we put sanctions on people. This is what we did to Iran, what we're doing to North Korea, what we might be prepared to do to Russia and China. So what Secretary Mnuchin was talking about, kicking China out of the dollar payment system. That's like cutting off the oxygen supply to a patient in intensive care. They're going to die pretty quickly. So it's a very, very powerful tool. The problem is the U.S. has thrown its weight around so much that we've actually created incentives for adversaries and rivals to get out from under it. But the point is, it doesn't happen overnight. And a good case study is how did the U.S. dollar replace pound sterling as the leading global reserve currency? Because that did happen. In 1913, sterling was the leading global reserve currency, hands down. In 1945, it was the dollar. What happened between 1913 and 1945? Well, a lot happened, including 2 world wars. But my point is, that was a 30-year process. It began in 1914 when the UK was in World War I, and we weren't. The U.S. was neutral. We got into World War I in 1917, but from 1914 to 1917, the United States was technically neutral, but the U.S. was a combatant. Obviously, they were in the war. They needed war material. They needed wool. They needed clothing. They needed agricultural goods. They needed weapons. They needed, ammunition, etc., all of which the U.S. could supply. But in those days, under the gold standard, we got paid in gold. So we drained a lot of the UK's gold and a lot of the Commonwealth gold, and it all went to the Fed at the time. Later, the Treasury took the Fed's gold. That was a separate story in 1934. But it was all going to the Fed at the time. The Fed was brand new in 1914. And but that was the beginning of the end of sterling. But it didn't happen overnight. It happened in stages. The sterling devalued in 1931. Then the U.S. dollar struck back, devalued in 1933. But then sterling devalued again in 1936. Then you had Bretton Woods in 1944, where our plan trumped Keynes' plan, et cetera. So the point is, it was a 30-year process. It happened, but it didn't happen overnight. Something very similar is going on right now. There is a long-term process to displace the dollar, to make the dollar something not much more than a local currency, kind of like the Mexican peso. We'll still have dollars. You and I go out for a drink, we'll still pay the bill in dollars. If you're a tourist from around the world, you come to the United States, you'll still need dollars. But it won't be the benchmark global reserve currency. Now, right now, today, the dollar is 60% of global reserves, 80% of global payments, and almost 100% of the oil market. It was 100% of oil shipments almost are priced in dollars. That's a huge amount of inertia. That's a huge embedded advantage. But Russia and China and others are chipping away at that little by little, the same way the U.S. did with sterling beginning in 1914. So again, I don't look for like we all go to bed one night and we wake up the next day and the dollar is gone. I mean, that's not going to happen. But confidence is being eroded. There could come a shock where it does happen a lot more quickly than even the elites are planning, even the Chinese and Russians expect. And there are many threads to that story. So one of them is the one you mentioned. So what China did, it's not like one big revolutionary act. It's more like a combination of 3 or 4 separate contracts that if you string them all together with straight through processing, you can get to where they want to get to, which is China's saying, hey, we need to buy oil. We don't have that much oil. We're the biggest oil importer in the world. We want you, meaning Russia, Saudi Arabia, and others, to sell us oil in yuan. But you're Russian. You're like, well, I could sell you oil for yuan, but what am I going to do with the yuan? There's no global bond market. I got no place to put the yuan. All I can do is buy stuff in China. Nobody's going to sell me anything in Germany with yuan. What am I going to do with them? And China says, no problem. We have the Shanghai Gold Exchange, and you can take the yuan that you get for the oil and sell the yuan and get gold. And you're like, yeah, okay, I like gold. That sounds good, but that's gold's volatile too. It moves up and down in euros and yen. And China says, no problem. We have the Shanghai Gold Futures Exchange, and you can sell your gold forward and hedge that exposure. So by combining an oil contract, a spot yuan for gold contract, and a gold futures contract, you can string it all together so you have a yuan-denominated oil market with the ability to convert to gold and ultimately to hedge in other currencies if you want to. That's up to the user. Well, that's an interesting package. What it does, it gets the ball rolling in ways that otherwise would not be possible on a benchmark yuan price for oil. That's the end of the petrodollar. The petrodollar, of course, was the Henry Kissinger, Jerry Parsky, William Simon, Helmut Sonnenfeld plan. Launched in 1974.
It was brilliant.
It was brilliant. It worked like a charm for 40 years. I actually met with Helmut Sonnenfeld was Kissinger's deputy national security advisor. His nickname was Kissinger's Kissinger. He was also German, deep thinker, big intellect, and I met with Helmut in the White House in 1974 to work on a plan to invade Saudi Arabia and take the oil fields. And the idea was that not that we would steal the oil, but that we would control it, sell it at a price of our liking, and then we could give the Saudis the dollars later, but they wouldn't control the price. Fortunately, that plan never went anywhere. It was a contingency plan, but it was also a gun to the head of Saudi Arabia. That plan was used as a threat to get the Saudis to go along with the petrodollar deal. We sort of said, hey, you can be our friends and price oil in dollars, or if not, who knows what's going to happen to you. That was the other. It was a carrot and stick approach. Saudis very wisely went for the carrots, which was you would price oil in dollars, then we would pay you dollars. You, the Saudis, could take the dollars and put them in the American banks, primarily Citibank, where I later worked for about 10 years. And then Citibank would lend the money to Brazil and Argentina and emerging markets, and then they would buy U.S. goods, and then we would get the dollars, and we could buy more oil, and the whole world would get rolling again. It was a big circle of dollars, exports, oil, et cetera, all based on pricing oil in dollars. And since everybody needs oil, and if oil is priced in dollars, then guess what? Everybody needs dollars to get the oil, and that propped up the global dollar market and got us where we are today. Nice job, but that is coming to an end. And it's coming to an end in more ways than one. Russia has tripled its gold reserves in the last 10 years. China has tripled its gold reserves in the last 10 years, more than tripled. China is now pricing oil in yuan. There's distributed ledger technology, which Christine Lagarde talked about the other day, head of the IMF, to have a global cryptocurrency. I'm not talking about Bitcoin. The IMF is not saying buy Bitcoin. What the IMF is saying is use distributed ledger technology, the so-called blockchain, as a way to disintermediate SWIFT, disintermediate the U.S. dollar payment system, and let's have the global currency. Let's have the SDR. So again, are these things happening in extreme form overnight? No. But are they happening relentlessly, persistently, in a way that will ultimately erode confidence in the dollar? The answer is absolutely yes.
And you don't see anything that would knock the U.S. out of the box or knock the global economy out of the box. A lot of people are very scared about, fearful about October. It's the month of crashes. Do you see anything quickly before we go on to currency wars? Your new extenuation of currency wars in the age of Trump. Do you see anything happening in October to fold the global economy or the U.S. stock market?
Well, there is one thing I'm keeping an eye on, Greg, and you've heard me talk before about the snowflake and the avalanche. And that's a good science, good math, good system dynamics. It's what we're using at Merrill Glim. It's a good way to understand capital markets, and it's not just a metaphor. It's actually good science. One of the reasons I don't use the phrase black swan, or I don't like the word black swan, is because it's not scientific. It's a kind of metaphor. It's a phrase people throw around to mean, stuff happens unexpected and it causes a panic. Yeah, I understand all that, but I like to use scientific terms, and the technical term for a black swan is a phase transition in a complex dynamic system. But that's what an avalanche is. So the snow builds up and it builds up and it builds up, and it's unstable, and anyone can look at it and say that whole mountain of snow is going to come crashing down. There's going to be an avalanche, and it only takes one snowflake. One snowflake lands the wrong way, it disturbs a few more, it creates a chute, it creates a slide, it gathers momentum, it rips the mountain loose, and then comes the avalanche, and it kills some skiers and buries the village below. So that's more than a metaphor. It's the same dynamic systems analysis. So given that as a baseline, the snowflake could happen any time. It could happen today. It could happen in mid-October. It could happen 2 years from now. The question is not the snowflake, which is always going to happen sooner or later. If it's not one snowflake, it's another. By the way, most snowflakes don't cause avalanches. Most snowflakes just pile up and give you more snow. But a certain snowflake, you can never predict which one, will cause an avalanche. Now, so it could happen at any time. But in particular, we have a window from October 10th to October 21st. Now, what's the significance of that window? October 10th is the anniversary of the creation of the Communist Party of North Korea. Kim Jong-un is getting ready to test more missiles. We can already observe them. They've left their assembly manufacturing area, and they're being moved to a launch area, and these can be observed by satellite. So those missiles are already on the move. Kim Jong-un likes anniversaries. It's a celebration for him. So they do tend to do these launches on these anniversary days. So October 10th is one window. I don't want to put a stake in the ground and say he's going to launch a missile on October 10th. I'm just saying that's the beginning of a window I'm watching. The other end of the window, October 21st, there's going to be a joint U.S.-South Korean naval exercise, or war game, if you want to call it that, where we're moving the aircraft carrier, the super carrier Ronald Reagan, into position. Right now, today, as we speak, the Ronald Reagan's in Hong Kong, but it will be making its way to Korean waters over the next 2 weeks. Kim Jong-un hates these war games. He did his H-bomb on September 3rd and did some missile tests in, I think, August 28th in response to a U.S.-South Korean war game that commenced on August 21st. So that was kind of easy to call, and I did call that. I did say in mid-August you're going to see missile tests and other weapons tests in late August, early September, because of this war game. Well, now we're in the same scenario. We have two catalysts, an anniversary on October 10th and a war game on October 21st. In that window is when I expect one or more missile tests, and that's going to be another wake-up call to markets. Markets are sleepwalking. They're complacent. They don't understand that this war is coming, which it is coming.
You think you're calling definitely for a U.S.-North Korea war, and which
yes.
would involve China and Russia, is what China and Russia say.
Well, it will certainly involve them in one way. Whether we can contain that to a diplomatic challenge with China and Russia, whether they would get actively involved, remains to be seen. Hopefully the former. But a shooting war, kinetic war, an attack, really, a preemptive war, preventive war with the United States against North Korea, I do expect by mid-2018. So, that window would be March, April, May, maybe June 2018. And, what the French call la logique de guerre, or the logic of war, is very apparent. The logic of war is different than the logic of diplomacy. It's different than the logic of finance. It's a logic unto itself, and you have to understand it on its own terms to see why this is happening. But Kim Jong-un is in breakout mode in terms of his weapons development. Breakout mode is a term of art. Normally what you do, look, all these activities, these missile launches, this uranium enrichment, the weapons test, it's all illegal under international law. It's all banned by treaty or prohibited by United Nations sanctions, or prohibited or subject to U.S. unilateral sanctions. None of it's, street legal, but countries do it anyway. The question is, can you get away with it? How do you get away with it? A lot of it's done in secrecy, which is what the Iranians are doing. A lot of it's done slowly, do it in little baby steps so that people don't get alarmed, or they get a slap on the wrist and you back off and you do it again, etc. Breakout is different. Breakout is when you don't care. Breakout is like, I'm going for it. I'm Tom Brady. I'm the Patriots. I'm in the red zone. I'm going for the end zone. I'm going to put points on the board. I'm not trying to hide it. I don't care what anybody says. Once you're in breakout mode, you're extremely vulnerable to retaliation. So your incentive, far from taking baby steps so no one does anything, when you're in breakout mode, you want to go as quickly as possible so you can get over the finish line before somebody stops you. That's the mode that Kim Jong-un is in right now. And he thinks he's safer with the weapons than without them. What's the logic there? Everyone's saying, you crazy? Don't you know if you get these weapons, the U.S. is going to come in and rain down fire and fury? He doesn't believe that, and with good reason. You look at recent history, the last 20, 30 years of U.S. Military and diplomatic history, Libya had a nuclear weapons program. They gave it up voluntarily, handed the keys over to the CIA. We invaded Libya. Gaddafi got killed. Saddam Hussein had a nuclear weapons program, not in 2003 when we invaded, but in the late 1980s, early 1990s. He gave it up. We invaded. He got killed. The Iranians have a nuclear weapons program. They have not given it up. They're still standing. So Kim Jong-un says, well, this is easy. If you give up your nuclear weapons program, the U.S. invades you and kills you, which we did with Gaddafi and Saddam Hussein. But if you keep your program, they don't mess with you, which is true of the Iranians. So I'm going to keep my program so you guys don't mess with me. So he thinks two things. He thinks we're bluffing, which we're not, but he thinks we are because, remember Obama put a red line down with with Bashar al-Assad in Syria about chemical weapons. He said, if you use these chemical or biological weapons, that's a red line. Don't cross it. There's going to be a price to pay. Assad walked over the line, used these weapons on his own people. The U.S. didn't do anything. So Kim Jong-un takes as a signal that, you have no appetite for war, you're bluffing, etc., combined with the other dynamic I explained already, which is that he thinks he's safer with the weapons. He's going for it. From the U.S. perspective, however, we're not bluffing. This is an existential threat. No admiral or general or certainly commander-in-chief wants to lose an American city and 1 million American lives to a nuclear attack on his watch or her watch, as the case may be. Not only that, but, I'll say the liberals, the kind of mushy-headed people who, write for The Economist and the Council on Foreign Relations, they say, oh, well, don't you know this war will be horrific? Don't you know the price will be too high? There'll be loss of life in South Korea. You can rely on normal deterrence theory to keep Kim Jong-un in line. Well, the first two things are true. It will be horrific and there will be a loss of life in South Korea. But the last thing is not true. You cannot rely on normal deterrence theory. Deterrence theory says, North Korea has nukes, the U.S. has nukes. They would be crazy to use them on us because we'll come over and wipe them out. That's not clear. First of all, there are a lot of things you can do with the nuclear weapons other than attack the United States. You could attack South Korea, for example. You could drive a wedge between the U.S. and Japan, drive a wedge between the U.S. and South Korea. What's the United States going to do? Trade Seoul for Seattle? We'll rise to the defense of Seoul. Kim Jong-un fires a missile at Seattle. We lose Seattle. Is that a good trade? I don't think so. It undermines the credibility of the U.S. nuclear umbrella, and I would expect Japan to have nuclear weapons in pretty short order. That's destabilizing. These are all the bad things that happen if Kim Jong-un has nuclear weapons, even if he doesn't shoot them at us. Just the threat that he could changes the dynamic. So that's one reason not to let him have them. But beyond that, so he shoots at us and we fire back. He just goes into his bunkers. I mean, he doesn't care about his own people. He doesn't care if his people get killed. They had a horrendous famine in the 1990s. People were eating bark off of trees. Nobody in the leadership cared. So they'll just go to their underground bunkers, wait out the attack, come back up, waving the North Korean flag, and proclaim socialism. So it's not clear that deterrence works at all. In fact, it pretty clearly does not. What you have to do is prevent him from getting the weapons, which is what we're prepared to do, and we're not bluffing. So what you have is this mismatch.
And when you say we're not, you say that as if you know that from insider information. We're not bluffing. You've said it a couple of times. Do you have insider information? You do not have to disclose your sources, but did you get it on good sourcing that we are not bluffing?
Look, I think it's out there. I just think the market doesn't read the signals correctly. Just look at General Mattis. General Mattis said publicly, this will be a bloody, horrific, costly war. Why would he said that unless we were getting ready for war? General McMaster said we've been kicking the can down the road. We're out of road. Well, out of road means out of road. It means we're heading for war. Donald Trump said fire and fury. Donald Trump said that Rex Tillerson was wasting his time on diplomacy. You don't say things like that if you think diplomacy is going to work. My point is, Greg, it's not that I broke into a vault in the Pentagon and stole some secrets. I didn't.
But you're a connected guy. I mean, come on. Give yourself some credit. You worked for the CIA playing war games. Remember that? You came home and said to your wife, "I have good news and bad news." Well, what's the bad news? Well, we lost. What's the good news? I played China. What's the bad news? We lost.
Yeah, well, it was the other way around. I said the good news is my team won.
Okay, right.
The bad news is I played China. Right. Yeah. Look, okay, so I had lunch in Washington last week with the top national security advisor to the Standing Committee of the Politburo. This is a university professor, but she runs the National Security Institute and is looked to as an advisor to senior leaders in government. She was visiting Washington. She was meeting with Ash Carter, former Secretary of Defense, other government officials. I believe she was meeting with McMaster. I'll be meeting with McMaster and Mike Pompeo, head of the CIA, in a couple of weeks in Washington in a small group, private setting, invitation only. So yeah, I get some. But my discussion with the Chinese national security advisor was very interesting because she said to me, China doesn't believe that the U.S. will attack. In other words, China thinks the U.S. is bluffing also. I said, well, just to be clear, we're not bluffing, and that makes war more likely. Because if you took us seriously, you would be doing more yourselves to prevent it from happening. The fact that you think we're bluffing means you're not doing everything you can, which makes the war more likely, not less likely. And I hope you take that message back to Beijing. We also talked a little bit, just to kind of go to this issue, Greg, about the casualties. We also talked a little bit about a secret weapon. Now, when you say something like that, people roll their eyes and go, "Oh, what are you, what are you talking about? Secret weapon sounds like something out of a spy novel." Well, remember, the atomic bomb was a secret weapon right up until the minute we dropped it.
Mm-hmm.
Right?
Yeah,
Nobody. We dropped it. Actually, even after we dropped it, it was a secret weapon because the Japanese didn't believe it. We had to do it again a couple of days later in Nagasaki. So that was a secret weapon. So what do you think DARPA and Raytheon and all these defense contractors have been doing in Los Alamos National Laboratory? What do you think they've been doing the last 10 years? Sitting still? Of course not. We've got secret weapons. We don't know what they are, but we may find out. And these could be there's a certain kind of non-nuke nuke. It's a subcritical weapon that has the destructive force of a tactical nuclear weapon without the radiation. Is that
Perfect.
a nuke? Is that a nuke or not? I don't know, but it sounds like it's enough to wipe out this North Korean artillery. Pardon me. It sounds like it's enough to wipe out this North Korean artillery before they do as much harm in South Korea as some people expect. That could be very effective. That could strengthen our hand. And so I would be surprised if we didn't have a secret weapon. Let's put it that way. And then my Chinese point of contact said, yes, that indeed Ash Carter had mentioned that to her. So, look, a lot of this, Greg, I think is hiding in plain sight. I don't think I'm that much smarter than other analysts. I think what I do have is better methodology. I look at the same information, but I filter it differently. I use different models. And again, the models I mentioned earlier, complexity theory, Bayes theorem, behavioral psychology, and history, tell me things that other people don't see because they're processing the information differently.
So look out between October 10th and October 21st. Flashpoint, look out. That's your the probability. If we're going to have something, if the wheels are going to come off, it's going to come off there, and it'll be North Korea will be at the center of that. Correct?
Correct. That's one.
Okay.
Correct. I expect that. But even if the market shrugs it off, and by the way, that's what the market's been doing lately. Oh, gee, another day, another missile. It used to be North Korea fired a missile, the market would trade down 1 or 2%. Then it would hold its breath. Then it would go back up again. So finally, the trader said, well, what's the point of trading down? Let's just keep it up here and ignore the missile. And that's kind of where we are now. We've normalized these launches. That's a huge mistake. There's a reason there's so many launches. That's because they're getting ready to build an arsenal of nuclear-tipped ICBMs. We're getting ready to shut that down. We're moving closer and closer to war. So we've got this test window in mid to late October. We've got this market realization that the Fed's not going to raise rates. That's going to be cause a big violent reversal in bonds, gold, and the euro. And then finally, by I expect the spring, late spring, early summer 2018, we'll be in a war with North Korea, and that's definitely not priced in. So a very bumpy road ahead.
I wanted to get this up here because you're redoing this book, fabulous book, all bestsellers, all the books I've shown. It's just unusual. Congratulations. I mean, you're a four-time, your first, your second, your third, your fourth book, all hit bestsellers. That's like J.K. Rowling stuff over in the, and I mean, that's stunning. I mean, could predict that? Anyway, Currency Wars, and it's going to be, you're redoing this book. Actually, you're extending it. It's going to be basically a new book, Currency Wars in the Age of Trump. Just give me, I don't want you to give up all your stuff, but just give me a nugget of what the Currency Wars in the Age of Trump will look like.
Sure. One of the things I said in Currency Wars, Greg, that book came out in 2011, but of course, you don't do a book overnight. I started writing it in 2010. And one of the points I made then is I said, we're not always in a currency war, but when we are, they can go on for 5 or 10 or 15 years. And that prediction has played out exactly as I said. Here we are 6 years later, and we're still in a currency war. We're talking about labeling China currency manipulator. Right now we have a strong dollar, probably need a weak dollar to boost U.S. growth. Pardon me. So we're still in a currency war. But the book stops cold in 2011. Well, that's when I wrote it. That's when it came out. But at the time, gold was at an all-time high, and the dollar was at an all-time low. Since the book came out, gold has come way off the highs. It's back a little bit lately, but way off the highs. And the dollar has come off the lows. And so that's what currency wars are. It goes back and forth and back and forth. It's not all one way. It's not one currency goes to zero. Currencies don't go to zero unless you're Zimbabwe. Major currencies don't go to zero. They move back and forth. And so I love the book. It came out well. I think it was had a lot of analytic value, a lot of good history. People really enjoyed the book, but it stops cold in 2011. I want to freshen it up, bring it down to 2017, even into 2018. Talk about currency wars in the age of Trump. Talk about the kinds of things we've been talking about on this broadcast, and war with North Korea, Chinese acquisition of gold, Russia acquisition of gold, all of which has played out along the lines I described in 2011, but with a lot more effect. So it's got a long new introduction, a lot of rewriting. It's a new edition of the same book, freshened up. It's still going to be called Currency Wars, but I think of it as Currency Wars for the Age of Trump, kind of bring the story down to today, and hopefully the readers will enjoy it.
And just so I noticed this too when I was printing it off. If you look here close, it's it's yuan. I mean, this is very predictive. It's yuan and it's dollars, and we're still there. It's yuan versus dollars. We're still there in this book, which I think is pretty amazing that you put that out. You probably thought it up in 2008 or 9, or put it out in 2011. Last thing, and I just wanted to get this in, another one of your best-selling books, The New Case for Gold. A lot of people are saying that they're going to keep manipulating gold forever, and there's a new guy that Donald Trump is considering for the head of the Federal Reserve to replace Yellen. He's not happy about the manipulation in the gold market and things like that. Do you think the manipulation will end? Do you think the price of gold will revalue to some more normal level, because we have, 230 trillion debt in the world, and 20 trillion outstanding U.S. Currency debt or U.S. deficit?
Well, there's definitely manipulation in the gold market. There's no question about that. And I talk about how and why it's done in my book, The New Case for Gold. But I don't think the Fed is the biggest manipulator. I think China is, and with good reason, because China is playing catch up. The U.S. has 8,000 tons of gold. China, officially, they say they have about 1,800 tons. Pardon me, they lie about that. They actually have more, but how much more is a little bit of guesswork. But even if you put that at 3,000 or 4,000 tons, maybe more, they still have to catch up to get up to the 8,000 ton level of the United States, and hopefully more. So ultimately, sooner than later, I expect gold to go to $10,000 an ounce. That's not a number I pull out of a hat. I'm not saying that to be provocative. That's actually the math of the implied non-deflationary dollar price of gold in a world where you need to use gold either on a gold standard or to bolster confidence in the U.S. dollar, which I do expect. But the point is, right now, China needs more gold. So if you were out to buy 3,000 tons, would you want the price to be high or low? Well, you'd want it to be low.
Why do they let that go on, though? I mean, they obviously dump all these contracts on the market, these naked short selling. Why would the U.S. allow China to do that?
Well, because who says the U.S. is in favor of a strong dollar? In other words, the U.S. is in on it. That's the point I made all along. This is the global elite's secret plan. This is, Tim Geithner is a friend of the SDR, went to the same graduate school I did, worked at the IMF. I mean, this is the long-term plan to promote the SDR. So who says the U.S. is necessarily against this? But what's the alternative? I mean, if you don't let China acquire the gold at bargain prices, they may have other incentives to attack the dollar outright. So the point being, yeah, gold is being manipulated, but it's being manipulated to allow the Chinese to acquire it at what they consider reasonable prices. Once they get all the gold they need, then everyone will be on board for much higher gold prices. But we're not quite there yet. Having said that, it could spin out of control. I mean, just because there's a plan doesn't mean things go according to plan. So my view is, what are you waiting for? Get a 10% allocation of physical gold today, and you'll be along for the ride.
The last question. A lot of people say the gold just isn't there at Fort Knox. Mnuchin went to Fort Knox and tweeted out it's almost sophomoric. Wow, happy the gold is safe or something. I don't know. Something like that. Thought that was bizarre. A lot of experts say the gold is not at Fort Knox, or there are many more claims on those bars than are bars. What say you?
Well, those are two different statements. First of all, a lot of people say the gold's not there. They're not experts. They're just, bloggers or whatever. I don't consider them experts. The gold is there. Now, having said that, it could very well be, probably is hypothecated, meaning subject to lease, through the BIS, the Bank for International Settlements in Basel, Switzerland. So gold can be leased for use by banks who then sell, 100 bars for every physical bar. So you acquire a lease, which is a paper title, but technically you own the gold, and then you sell 100 times as many unallocated forward contracts. So I don't doubt that the gold is being used to back up contracts that are used to suppress the price of gold. I think that's all very clear, but it doesn't mean that the gold is not in the vault. The gold is in the vault, but you just have this whole paper pyramid of leases and unallocated forwards and futures and et cetera, with a bunch of empty private warehouses all resting on a tiny little sliver of physical gold. But who's short in that scenario? If I'm J.P. Morgan, I lease gold from the U.S. government from the U.S. Treasury through the BIS, and then I go out and sell 10 times as much to a bunch of investors who think they're getting gold but aren't really. I'm the one who's short, not the Treasury, not the Fed. It's the bank. And so if all my customers come in for the gold at the same time, I don't have the gold. It's the bank that's short, not the U.S. government.
And so you said one time to me, this stuck with me, that the U.S. government wouldn't be stupid enough to sell all this gold. Maybe other people's gold, but they would not sell the U.S. gold. You still stick by that statement? They wouldn't be that stupid to sell their gold?
Sure. I mean, legally they may not be able to, because remember, how did the Treasury get the gold? They took it from the Fed. What did they give the Fed in exchange? A gold certificate. So they need at least enough gold to back up the gold certificate, and that just happens to be the amount of gold they have, which is 8,000 tons. Again, I talk about that in my book, The New Case for Gold. What the United States did when we wanted to suppress the price of gold, we got everyone else to sell their gold. IMF in the late 70s, UK in the late 90s, Switzerland in the early 2000s, IMF again in 2010. Canada is out of gold. We've been getting everyone else to sell their gold while we hang on to ours. It's a pretty smart move, if you ask me.
Jim Rickards, it's the Rickards Project, the JamesRickardsProject.org is his website.
.com, sorry.
.com. Oh, I'm sorry. JamesRickardsProject.com. They call it the James Rickard Project, but it's JamesRickardProject.com. Also, Miraglim, it's MERAGLIM. It's called Miraglim. That you can take a look at his predictive, analytic technology, and it's based on complexity theory. It's predictive. Four-time best-selling author. The Case for Gold. You have the Road to Ruin. You've got these are all on his website too. The Death of Money and the Currency Wars. This will be redone, completely redone. Basically, be a new book. Currency Wars in the Age of Trump. James Rickards, thanks for joining us today on USAWatchdog.com and giving us more than an hour of your time. Thank you so much, sir.
Thank you, Greg.